Our first competitive round. Here we go. Let's take a look at what we got going on. Stop here at the selected financial statistics. And what do we see? Well, we got some ROEs that are not doing too bad. Look at Andrews at 13.3. Quite a few negative ones. We got 3 teams with negative ROEs, so didn't make any money. But sometimes in the first round, the first year business can be a little difficult. Chester, our computer team, 7.4, but still quite a ways behind Team Andrews. Sales, Digby actually had the biggest sales, but didn't make a profit. It's kind of interesting. We'll need to know why. Huge SG&A to sales, so they're spending a lot of money there, as did Baldwin this particular round. Relatively speaking, Digby's at 22.2 on 141 million, so it spent quite a bit more. That's a lot of money, for the first round, spending it on SG&A, assuming that most of that, and rightfully we would assume that most of that's going to marketing, sales and marketing budget. We got some contribution margins that are over 30% already. Chester just below. Erie, on the other hand, well below that 30% mark, and we might have to take a look at why. I'm going to try to get through these a little bit quicker. We still got teams. I don't know how many times I say debt is cheaper than equity. How many times I repeat that? Now the computer team doesn't hear me, so it might sell a little bit of stock. But we've got 2 student-run teams still selling stock. It's diluting here, 20%, diluting its earnings per share by 20%. That may not seem a lot right now, but it can be extremely meaningful as the game goes on. Okay, because that dilution, unless you start buying back that stock, that dilution will continue. Bonds, we see Baldwin borrowed some money. Looks like Erie borrowed a little bit of money, and Digby borrowed some long-term money. Doesn't mean that they may not have borrowed some short-term money as well. Come down to the cash flow. I always like to kind of take a glance at some things here. Erie had a negative, net cash from operations of about $38 million. Really, if you look at that, it's all in inventory, right? So what's it tell you? Well, it had a loss, okay, but it got some cash back, kind of, if you want to call it that, because as a part of that loss was depreciation, okay, but depreciation's a non-cash expense. And then some extraordinary gains, losses, or write-offs. Probably got some gains from selling some capacity. Okay, we could look down, we can look at their capacity and see if that's the case, but it is. Okay, so pretty much a net wash there. You got a net wash between accounts payable and accounts receivable. So really, right, their total cash drain was probably a result you could attribute to the increased inventory, okay, and you saw some increased inventory otherwise too. Baldwin, Digby a little bit, and Ferris some as well. Plant improvements, though, man, look at that. Digby spent a lot on plant improvements. That's pretty impressive. Okay, we'll have to see what Digby did in terms of its plant improvements, right? Here's the sale of common stock. So again, the 2 student teams, $13,700,000, and both teams borrowed a little bit. Then Baldwin did borrow long-term debt, so borrowed quite a bit of money. It did end up with some cash on hand. Okay, the question was, could it have borrowed short-term, as opposed to selling common stock? I think it could have. I don't know what the limitations are in the short-term borrowing, but I think it could have without too many problems and finance some of this stuff. They did a pretty good job of financing their plant improvements, because that's just about even. You borrow $19 million, you put in a little over $20 million, so they just needed some short-term money. Doing that through sale of common stock, a very expensive way to do that. So we got a couple teams, that did get emergency loans. Okay, we've got Digby with $9 million and Erie with $33 million emergency loan. Cash, not a lot of cash. Ferris ended up with a decent amount of cash. Okay, here again, so they sold stock in the amount of $13.7 million, and they got $33 million in cash on hand. It just cost them a lot of money to sell that stock. They've diluted their stockholder base. They've done a lot of things, and all for what? To have some cash sitting in the bank? I hate cash in the bank. Well, I shouldn't say that. Cash in the bank's kind of nice as long as you got a plan for it. Again, inventory, we see some of those numbers, but we saw those up above. Total equity, I'm going to ask you some questions about equity or leverage on the assignment. Cruising through, see if there's things that jump out at you. Not in particular. We'll see some of those as we go along. Again, first round not totally unexpected, but we do have just tons and tons of capacity. Remember, I've asked you some questions about capacity. If every team has 5,000 units of capacity on average times 6, that means there's 30,000 units or 30 million units of capacity times 2, 60 million units of capacity, and it looks like we only need about 25 million units of capacity. Okay, so there's all kinds of capacity. Cruise through these. The production analysis, we said that Digby spent a lot of money. Yeah, look what they did. Okay, now we know what they spent money on. They're introducing some new products. So 3 new products just right off the get-go. That's expensive. It's no wonder that Digby had a bit of cash flow problems, and they did have an emergency loan. They didn't fund it adequately, but that's really, really expensive. Okay. We see Erie getting going with some automation there. Baldwin's introducing a new product, a little bit of change in automation. Look at the bump up there in automation, though, in the low end from Cake and Cedar. Yeah, pretty impressive. So in the traditional, okay, another thing I have to repeat, customer buying criteria. And I'm going to pick on Erie here a little bit, right? So Erie sells their traditional product. They got by far the lowest price. Look at that, until you get down to Dell, which I think was a low-end product, if I'm not mistaken. They just happened to sell a decent amount. But Erie's product was the low-cost product, or low-price product. But, why didn't it sell better then? What's the number one thing? Ideal age. And where's Erie? Yeah, geez, you got 4. Whoops. Okay. You also see that they didn't spend much on the sales and marketing, but they'd have still sold a lot more had they been more concerned about the age versus the price. Price is the second most important component. It's probably why they sold as many as they did. They were, very well priced. And then ideal position, though, is almost as important as the price. Okay, so those two, but look at that. Those two combined aren't as important as the age. That makes up 44% of the customer buying criteria, whereas ideal age is 47%. So, you gotta push for those things that are important to the customers. Makes a huge difference. Okay. Did MTBF make a big difference? Doesn't really look like it. Abel had the lowest MTBF and yet still sold the most. Okay, good age, spent a reasonable amount there. Performance and size coordinates, a little bit better. Okay, so look at the same thing here in the low end. And once again, we'll pick on Erie a little bit because here Erie, right? Age was fine. 5.6. That's the same as the top sellers. We got folks there that had younger age, but that still sold more than Ebb. Okay, well, why? Well, price. Okay, Ebb's price was the highest, basically, of the low in the low end segment, and also didn't spend much money on marketing. But customer buying criteria. Okay? Just got to look at that in all of the segments and look. Each segment's different. Okay, each segment is different, and you really got to concentrate, and you got to go through these and determine why did this product sell better than us? What's the reason? Sometimes when it's the difference between 590 and 543, it can be really subtle. Sometimes it might even be just the revision date. Okay, so it can be really subtle. In that case, it might be the marketing, right? Marketing might have made a huge difference here, or not a huge difference, obviously, but a difference. This team spent quite a bit more on marketing than this team, a couple million more. So, look at it, each segment, determine, why is the number one team selling so well, and why aren't we selling any better, and then make your decisions based on that. In some cases, you may be moving your product out of a segment, for example. Well, your expectation should be that you aren't going to sell much more. So you don't want that product necessarily to try to match up with the top seller, okay? But then you need to make good predictions about what you will sell, okay? Obviously a smaller amount. You might just be able to pick up a few scraps if you're transitioning from one segment to another segment, and then be ready in the next segment, because you might be coming into that segment as a well-positioned, product. So, okay, we had some potential and market share differences. Main one I think was in the low end for product ebb. Actually did much better than its potential. So I think I've asked a question in the assignment that's a little bit backwards. Again, we're pretty congregated here. A question I'd have for Erie, and I'm not sure, it almost looks like they moved their high-end product back, okay? And their goal may be to try to get it into the traditional segment. That's fine, but you're spending money then to basically reverse engineer a product. Time would take care of it, okay? Let's not spend money to reverse engineer products when time will take care of it. Now, if you were moving, say, your performance or size product and tried to get it into the traditional segment, yeah, you need to move it at least, that'd be laterally or horizontally, okay, in order to get it into that sphere, right? But you don't necessarily want to move it back that way, So this one you might want to move this way. This one you might actually have to kind of move this way, because remember your traditional product, kind of same with that one, your traditional product is going to be moving that way, or the traditional product customer demand. Okay, I think we don't have HR, we don't have TQM quite yet, so that's pretty much it. And again, really pay attention to, those little subtle things. They're going to start making a huge difference as you guys all start to figure out the game a little bit more. Subtle things are going to pay off. They're going to be a huge difference maker as we go along. And again, and I told this, I had some students come in and talk to me a little bit about it, so I'll pass it along to everybody. The team that more aggressively but not recklessly pursues its strategy is probably going to be successful and probably be the most successful. If you went back and you looked at the review that I did for the assignment 5P, you'll note that while Chester was pretty victorious, they did pretty well in the practice rounds. That's our computer team, right? Beat the student teams, but in my opinion, they were not even moderately aggressive. Okay, so in terms of aggressiveness, there's a lot that you can do that is still. I'm never going to say something's risk-free, but that's really relatively low risk, and you can still be very aggressive. And I'll say as a group, including the computer team, we're not even close to that level of aggressiveness. So good luck in round 2.